Welcome to The Responsible Resident. I'm Amber Stitt. This podcast takes a common sense approach to financial decisions for physicians, breaking down complex topics into something clear, practical, and usable. Because you shouldn't have to have a finance degree to build financial freedom. Welcome back to the Responsible Resident podcast. I'm Amber Stitt, and if you've been following this series, you know our goal is simple: to help residents, fellows, and early career physicians better understand disability insurance, underwriting, and the financial decisions that can shape your future. And as we continue building out this series, we're adding in bonus episodes covering important concepts, the kinds of details that can make a major difference in how your benefits actually work when claim time comes. Because understanding disability insurance isn't just about buying a policy, it's about understanding how benefits are actually paid when you need them most. And today, we're tackling a question that often comes up as residents transition into practice, especially if you're moving into private practice, partnership, 1099 work, locums, independent contractor roles, or eventually self-employment. The question is, should doctors deduct their disability insurance premiums? And even more importantly, what happens to your benefit if you do? Now, before we begin, an important disclaimer. This episode is for educational purposes only. Tax laws can vary depending on your state, business entity, and personal financial situation. You should always defer to your CPA or tax advisor for individualized tax advice. But in general, this is how the tax treatment often works. At first glance, deducting your disability premium sounds like a smart move. Lower taxable income, potential tax savings, another write-off. Sounds efficient. But with disability insurance, there's a trade-off, and many physicians don't fully understand it until much later. Here's the general rule. If you pay your disability insurance premiums with after-tax dollars, your disability benefits are generally received tax-free. But if you deduct those premiums as a business expense, or if they're paid using pre-tax dollars, your benefits are generally taxable if you ever go on claim. That sounds like a small detail. It's not. Because disability insurance is not purchased for your healthy years. It's purchased for the years where everything changes. Think about it. Your income supports a lot. Mortgage, student loans, childcare, retirement contributions, lifestyle expenses, and family support. The policy exists to replace income if illness or injury interrupts your ability to work. But this is where many physicians make the mistake. They focus on saving taxes now instead of protecting usable income later. I'd like to take a second to tell you about a free medical professionals blueprint that I created with you in mind. At some point in your career, you realize it's not just about making more money. It's about making decisions that actually support your life. That's exactly why I created the Pathways Perspective for Physicians. It's a simple, non-technical framework to help you think through your career, your money, your risk, and how everything connects as your life evolves. You shouldn't have to have a finance degree to build financial freedom. You don't need to have everything figured out. You just need a place to start. You can download the free Medical Professionals Blueprint at stittstrategies.com/blueprint. Let's walk through an example. Let's say you're paying $3,000 per year for an individual disability insurance policy. That policy pays an $8,000 monthly benefit. And if you deduct the premium today, maybe you save a few $100s this year. Feels good. But what happens if you become disabled later, and that $8,000 benefit is taxable? At a 24 to 32% tax bracket, you could lose almost $2,000 every month to taxes. That leaves you with around $6,000, not $8,000. And that's important because disability insurance already replaces only part of your income, not all of it. So if taxes reduce that benefit further, the gap can become much bigger than expected. That difference may affect housing, debt payments, childcare, savings, lifestyle, and recovery time. This becomes especially important as physicians move from W-2 income into self-employment, because suddenly everything starts to look deductible. Licensing, malpractice insurance, CME, office expenses, technology, professional dues, and business travel. But disability insurance is different because it protects you, not your business. That distinction matters. And this is often where physicians heading into private practice or partnership start asking better questions. Not, can I deduct this? But what leaves me with the most real income if I can't work? That's the better question. Now, there is one important exception here, and that's business overhead expense insurance, often called BOE. BOE is designed to reimburse business expenses if you become disabled. Things like rent, payroll, utilities, equipment leases, and office overhead. Because BOE protects the business itself, those premiums are often deductible. Different purpose, different tax treatment. But your personal disability policy, that's designed to protect your earned income. And that's why the tax treatment becomes so important. For many physicians, preserving tax-free benefits often creates the stronger long-term outcome. It may feel less efficient in the short term, but much more protective in the years that matter most. And remember, a disability contract isn't about creating tax savings in a good year. It's about preserving options during a hard year. Your ability to keep your home, support your family, protect your years of education and training, maintain financial stability, and buy yourself time to heal. That's what this planning is really about. And as your career evolves, especially if you're moving into ownership, partnership, or independent income, these details matter more. Because once your income structure becomes more complex, the planning needs to become more intentional. And understanding how benefits are taxed at claim time is part of being a responsible physician. That's why we're adding these bonus episodes, because sometimes the small details in a contract make the biggest difference when life changes. Thanks for joining me for this bonus episode. If you're transitioning into practice and want help reviewing your disability insurance, understanding how benefits may be taxed, or evaluating your options as a future self-employed physician, our team at MD Disability Quotes is always here to help. And if you want to build your education-first financial foundation, visit stittstrategies.com/blueprint. Until next time, stay informed, stay protected, and stay responsible. If this episode helped you think a little more clearly about your next step, that's the goal. You don't need to have everything figured out, but you do need to take ownership and take a meaningful step forward today. Thanks for listening to The Responsible Resident. As a reminder, this podcast is for general educational purposes only. It is not legal, tax, or individualized financial advice, and coverage options will vary based on your personal situation.